Hello, I'm Rich Hammar, attorney and CPA, and I'd like to discuss with you today 10 year-end tax responsibilities for churches. You know, the end of the year is upon us, and the attention of church leaders is directed toward programs, holiday programs within the church. And as a result, we can easily become distracted and lose sight of a number of very important tasks that should be done by the end of the year pertaining to tax compliance. I'd like to mention 10 of those with you today. And the first one is the designation of a housing allowance for ministers on staff. The housing allowance is a significant tax benefit for ministers, and what it says is that the portion of a minister's compensation designated in advance by the church as a housing allowance is not taxable for income tax purposes by the minister to the extent the allowance is used to pay for housing expenses and does not exceed the home's fair rental value plus utilities. But the key is that the allowance must be designated in advance. I see this happen all the time where churches fail to do so. They're caught up in the end of year programs and activities of the holiday season. Oh, you know, we forgot to designate a housing allowance. Maybe somebody discovers that in April or May, or maybe not until January of the next year. But in any case, if you do not designate the allowance in advance, it's not permissible. You can't use it. Now, that doesn't mean it has to be in advance of the year. It should be. But if you find out in May that we didn't designate a housing allowance for this year, you can still designate one from that day on for the rest of the year. Prospective application, not retrospective or retroactive. So this is something that should be on the church calendar every December for the church board or congregation. Some churches, it's actually the congregation, the membership itself that designates the housing allowance. That's not common. It does happen. But whoever is going to be designating the housing allowance for ministers, that should be done by the end of the year. I also recommend that you have what I call a safety net housing allowance, where you have a continuing resolution by the board that, unless otherwise stated, the housing allowance for every minister on staff of this church shall be, fill in the blank, say 40% of the compensation of that minister. Now don't rely on that. That's just a safety net in the event that you fail to designate an allowance for a minister. This gives you some basis for enabling that minister to claim the allowance. But I still recommend an annual specific allowance for each year. Very important responsibility. And again, let me emphasize, you can't do this retroactively. So if you fail to do this at your church and you find that out next October, you can't go back and designate a retroactive allowance. And part of that is for the reason that the allowance is non-taxable only to the extent that it is used to pay for housing expenses. Well, how can you retroactively designate the allowance after those expenses have been paid for? So it makes sense. And remember, the housing allowance is non-taxable only for income taxes, not for Social Security or self-employment tax purposes. So that's the first responsibility, making sure a housing allowance is designated. And by the way, for those of you that have a pastor that lives in a parsonage, you can designate a portion of that person's compensation as a parsonage allowance to the extent that minister incurs any out-of-pocket expenses of living in the parsonage, such as utilities, furnishings, insurance, etc. Okay, let's move on then to the second year-end tax responsibility, and that's W-4 form. So W-4 is the IRS form on which employees declare withholding allowances. It's called the withholding allowance certificate. And so your allowances are based on your exemptions, your dependents, your deductions, the amount of income you're going to have. That will determine how much tax is going to be withheld, income tax is going to be withheld from an employee's wages over the course of the year. But this can change. An employee's spouse gets a second job, or is employed, or loses a job, or an employee is divorced, or an employee has a child. There's a number of reasons why the W-4 can become out of date. And so I think the end of the year is a good time to provide employees at least with the opportunity to update their W-4 form. And that's something I recommend that this be done at the end of the year. Number 3 is a notice to your membership at the end of the year to caution them not to file their tax returns for the new year, for the previous year, until they receive their contribution receipts or summary from the church. And here's why I say that. So here we are in December of 2013 to advise your membership in church services, church bulletins, church newsletters, church websites, not to file their 2013 individual income tax return until they receive their annual contribution statement for 2013 from the church, which will obviously not be obtained until sometime in 2014 in the new year. That can be January, that can be February, maybe even later than that in some cases. But the point is this: the substantiation requirements for charitable contributions were tightened up several years ago. And one of the requirements now is that the church must issue a contribution receipt to donors who make individual contributions of $250 or more. They must receive a contribution statement by the later of April 15th, or the date they file their, or the earlier, or the date they file their tax return. So here's the idea. If you have a member of your church who wants to get their tax return in early because they're going to get a big refund, they have an incentive to do it in January. Well, what if they have made contributions of $250 or more to your church over the course of the year, sometimes much more, and they filed their tax return before they received the contribution summary from the church? That means that they don't get to deduct these contributions because they have failed what is called the contemporaneous requirement. And that is that the contribution statement must be received by the donor before they file their tax return. So it's very important to warn, to caution your membership not to file their 2013 individual income tax return until they receive the contribution summary from the church. And then a fourth year-end responsibility that I think is worth noting is Christmas gifts. It's common for churches to provide gifts to staff members at year end. Maybe it's a gift certificate of $50 to a restaurant, or I've seen these happen in many, many different ways. And people tend to think that because it's a holiday gift, it's non-taxable. And that is usually not the case. Holiday gifts generally should be valued and added to the W-2 for those employees at year end. Now, one exception would be de minimis items of property, not cash, but items of property that are so low in value that it would be impracticable to account for them. That's called the de minimis fringe benefit. And the IRS regulations give examples here of turkeys and fruitcakes. So if you provide that, if you provide a fruitcake to your staff, you don't have to value that and add that as taxable income. By the way, there was a study done recently that fruitcakes, there is, in general, I think it's 34% of Christmas gifts are rewrapped and given away to somebody else. But the one exception to that is fruitcakes. I think it's close to 100% of those are rewrapped. And so if you ever look at the expiration date, sometimes it's a decade old. These things, nobody ever eats them. And they just keep shuffling them around to family members. You may end up getting the same fruitcake you got 10 years ago. So, but that's an exception. Any kind of cash or cash equivalent is not, it cannot be a de minimis fringe benefit. Well, what if it's under $25? Isn't that there's no $25 rule. If it's cash or a cash equivalent, if it's a $10 Starbucks card, you've got to report that as taxable income to that employee. Well, what about volunteers? You know, I teach a 5th grade Sunday school class, and I've done it for 25 years. I get a $5 Starbucks gift certificate at Christmas. Hey, I'm not doing this for that certificate, believe me. And I never use it, I give it to somebody else. But is that taxable income to me? Yes. Well, so does the church have to give me a 1099? Of course not, because they're not giving me $600 or more of compensation during the course of the year. So that's up to the individual volunteers. You have no reporting duty unless you're giving $600 or more of benefits to these people, which would be extraordinary. So make sure you properly value Christmas gifts that you provide to staff, whether they're employees or volunteers, and comply with the reporting of income as appropriate. Number 5 is handling year-end contributions correctly. How often do we see this? You know, here's somebody in the first worship service of the new year, 2014, let's say, in January, and the pastor will say, if you want a contribution deduction for 2013, just predate your check to December of 2013, and we'll be sure to allocate it to last year. You can't do that. A contribution occurs in the year, on the day that it's delivered, or in the year it's delivered. So that check that is delivered in January of 2014 to the church, the date of delivery is 2014. And so it can't be claimed as a 2013 contribution. That is absolutely the rule. There is one limited exception, and that's called the mailbox rule. And that says that if you mail and postmark a gift in one year and it's not received until the next year, it is deductible in the prior year. So if I write a check out to my church for $1,000 on December 30th of 2013, and I send that to the church and it's postmarked 2013, but they don't receive it obviously to 2014, that is deductible in 2013 under the mailbox rule. But when you're talking about personal deliveries where you write the check maybe at home or at church, but you deliver it in church, it's the year of the delivery that determines when it's deductible. And if that's in a service in January, you can't predate that to 2013 and have that reported last year. So be sure that you handle year-end contributions correctly. Number 6 is be sure that you wrap up any business expense reimbursements. You know, many churches, most churches do reimburse business expenses for staff. You know, and it's good to wrap those up by the end of the year. It's not required, but so you start with a clean start in the new year. Make sure that employees are urged sometime in early to mid-December to get those business expenses in so the church can properly reimburse them. And the next one, number 7, is reclassification of workers. And many churches, I've seen this over the years, will report workers as self-employed so that we don't have to withhold income tax from their pages, or from their compensation, or FICA taxes for that matter. And they play fast and loose with this, and they try to treat people that are basically employees as self-employed to minimize the church's tax reporting responsibilities under the payroll tax reporting rules. You can't do that. If the person is an employee, the person must be treated as an employee. And if that person's working 10, 15, 20 hours or more a week, that person is not self-employed, is not a contractor. That person, 99% of the time, is going to be an employee. And there are penalties to any employer, including the church, if you incorrectly report somebody who's in fact an employee, as a self-employed, that the IRS later reclassifies as an employee. So there are certain risks in treating a worker as self-employed, especially if they're working a substantial number of hours, 52 weeks a year. But the point is, January 1st is a great time to reclassify those workers. So you don't do it mid-year, and there's all kinds of questions that can be, why are you doing this? You know, you're going to get potentially callbacks and by the IRS as to explain what's going on. January 1st is a great time to switch workers from self-employed to employee status, if in fact you want to do that. Now what about number 8? And that's voluntary withholding. Ministers' taxes are unique in a number of respects. But let me just mention 2 of those that have caused the greatest confusion when it comes to clergy tax reporting. And those are, number 1, ministers are self-employed for Social Security with respect to compensation they receive for performing ministerial services. What that means is they don't pay FICA taxes. They pay self-employment taxes. And that means the church doesn't pay half. The self-employed worker pays the full 15.3%. And so that's the first rule. I see this happen all the time. Ministers are treated as employees for income tax purposes, so the church treasurer treats them as employees for Social Security, withholds FICA tax. That is incorrect. The second unique rule is that ministers' wages are exempt from income tax withholding. They pay not from income taxes, but from income tax withholding. Ministers use the estimated quarterly tax procedure to prepay their taxes, both self-employment tax and income tax. So, but some ministers, and this is something I recommend actually, have elected voluntary withholding. It's hard to budget for those 4 quarterly tax payments every year. And wouldn't it be better if the church just withheld taxes from me like they do with employees? And it's easier, it's less painful to do it that way than planning for those 4 quarterly payments. So voluntary withholding is an option that you should consider, where you fill out a W-4 as a minister, and you indicate how many withholding allowances you're going to claim, and that determines how much income taxes are going to be withheld by the church as your employer. Now, the one thing to keep in mind is that if you're not exempt from Social Security, you are self-employed for Social Security and pay the self-employment tax. And you're going to have to use the estimated tax procedure to pay that, unless you, on your W-4, put an additional amount on line 6, an additional amount of income taxes to withhold, in addition to what the tax tables indicate based on the number of your withholding allowances. And so the additional amount, which is your estimated self-employment tax liability for the year divided by the number of pay periods, that becomes a credit against your self-employment tax liability and ensures that you don't have any delinquent payments and there's no penalties. So that's what I would recommend, is that you, on that line 6 of your W-4 form, withholding allowance certificate, you list an amount to cover your self-employment tax liability for the year. And again, this is not as FICA taxes, it's additional income taxes that are being withheld. And that's the way it's got to be reflected on the church's W-2 and 941 forms as well. Now, the 9th year-end task that I'll mention, of course, is ordering IRS forms and publications. And there's a number of forms and publications that of course, I would recommend, and those would include IRS Publication 15, which includes all the withholding tables. I would recommend, of course, W-2s, W-3s, 1099s, 1096s. Those are all important forms as well. And another one that's very important is the Form 8283 and instructions. Those are 2 things, the Form 8283 and the instructions to the Form 8283. That form is what the church needs to sign if a member of your church contributes property, non-cash property to the church valued at more than $5,000. You know, house, land, jewelry, etc. That donation is not going to be allowed unless it's properly substantiated. And in these cases, that requires an appraisal by a qualified appraisal. That's not just any appraiser. They have to meet the definition of a qualified appraiser. And then the donor has to fill out a qualified appraisal summary. And that's Form 8283, IRS Form 8283. Now, the instructions to that form go through all the requirements. And here's the point I want to make. If you have somebody that wants to make a contribution of property that you think may be valued at more than $5,000 to the church, you need to ask that person, are you familiar with the Form 8283, with the qualified appraisal requirement? Many times these donors are not sophisticated enough that they understand these rules, and they are jeopardizing their deductibility. I have seen contributions of hundreds of thousands of dollars that have been denied by the IRS because the donor didn't have this qualified appraisal and didn't include the qualified appraisal summary, the Form 8283, with his or her tax return. So now this is the donor's responsibility. It's not the church's, technically, but you're going to be blamed by donors, by members of your congregation who are denied a tax deduction because they made a substantial gift of property to you, and they didn't comply with this qualified appraisal requirement. So what's the point? Have every year replenish your supply of Form 8283s with instructions. Hand those to those donors that are making these gifts. Are you familiar with these requirements? Here they are, explained in the instructions to Form 8283. Take this, go to your tax advisor, make sure that you're complying with these, and that is a very important task you can perform. It's fairly complicated and it requires some level of sophistication to get this appraisal and to fill out the appraisal summary, but it's essential for gifts of non-cash property in excess of $5,000. There's a few exceptions like publicly traded stock that apply. And then, of course, specific rules apply in the context of gifts of cars, of vehicles to churches. And those are a separate set of requirements that you need to be familiar with those as well. If anybody makes a gift to the church of a vehicle, it's important for you to be familiar with those rules as well. And then the 10th and final task, there are many more we could talk about, would be to make sure that you order other tax publications and renew subscriptions. So for example, I do the annual Church and Clergy Tax Guide, and the 2014 edition is about to be published. And if you don't have that 750-page book, that's something I recommend. And I also published this biennial compensation handbook for church staff. Here's the hot off the press 2014-2015 edition that goes through several staff positions in a church and gives you all kinds of compensation data, so you can compare compensation that you're paying to your staff in every conceivable position with these national averages and see where you fit in. My church uses that. And then, of course, my Church Law and Tax Report newsletter, 32 pages bi-monthly, in which I attempt to cover what I consider to be the top legal and tax developments pertaining to churches and church leaders, church staff. This is a way for you to stay up to date on all relevant information. So here's the current edition, which the lead article is Stopping a Shooter. What do you do? How do you respond to workplace violence or to violence within the church? If somebody gets up and starts shooting people, how in the world do you respond to that? And I go through a number of ideas and recommendations there, some of them based on the FEMA guidelines for houses of worship that were released in mid-2013. And I build upon that because I think as good as those recommendations are, they don't go far enough. And I cover a number of other ideas there as well. Well, anyway, that concludes our discussion of what I consider to be 10 of really the more important year-end tax responsibilities for churches. And I hope you found that this information to be helpful. And for further information on these and many other topics, I would refer you to my 2014 Church and Clergy Tax Guide. Thank you.